So Dr. Ashten Duncan received his Bachelor of Science in Microbiology from the University of Oklahoma in 2016, Master of Public Health from OUHSC Hudson College of Public Health in 2019, and Doctor of Medicine from the OUTU School of Community Medicine in 2021. He completed his family medicine residency training at the UNM Santa Fe Family Medicine Residency Program in June of 2024 and is currently a core faculty member at Medicos de El Centro Family Medicine Residency in Española, New Mexico. His professional interests include Native and tribal health, outpatient medicine, lifestyle medicine, public health, academic medicine, and applied research in primary care. Robert Brock Frost completed his Bachelor of Science in Psychology from Weber State University. He concluded a postdoctoral internship in clinical psychology with an emphasis in neuropsychology at the University of Arizona College of Medicine and received his Doctor of Philosophy in clinical psychology with an emphasis in neuropsychology from Brigham Young University. Dr. Frost obtained his postdoctoral fellowship from the University of New Mexico Hospital and Clinics with an emphasis in adult neuropsychology and clinical applications of neuroimaging and received a Master's of Clinical Psychopharmacology from Fairleigh Dickinson University. Dr. Frost is a board-certified clinical psychopharmacology examination for psychologists, certified. In addition, Dr. Frost has published many abstracts and written book chapters. So with that, the floor is yours, and you can take it away from here.
Thank you for that great introduction. You can always pick somebody who's not from Utah.
Well, for that introduction. So we're back again today with another co-presentation. This time, Dr. Frost and I are reprising our roles on the financial health side. For those on the Santa Fe side who are probably in their third year at this point, you might remember our financial health series that we did last year, or at least parts of it. That was that 4-part series that we're now going to give the highlights on and also give a good overview for those who weren't involved. So we have a lot of material to cover, so I'm going to keep this all short here and we're going to get started. So just to kick us off here, let me actually get things a little reorganized here. The most important thing I think to say up front is that Dr. Frost and I are not financial advisors and we are not accountants. We are not going to be giving you anything that should be construed as financial advice, but we do want to give you some education on some basic concepts in personal finance and things for you to take forward with you. So one of the things that we would really encourage you today is if you have specific questions about your own financial situation, just go ahead and reach out to somebody. There are plenty of great resources out there, some free, some that come at a cost. So just be aware that those resources are available. But with that, we will go ahead and jump right in with our learning objectives. So by the end of this presentation, we want everyone to be able to, one, define basic investment terms and summarize the relative risk of different investment options. 2, contrast different types of individual retirement accounts and employer-sponsored retirement plans. 3, describe reasons to borrow money from a lender, different types of debt, and debt repayment strategies. 4, articulate what purposes taxes serve at the federal, state, and local levels, and what types of taxes affect individual taxpayers. And then lastly, we want everyone to be able to articulate clear personal financial plans and opportunities to improve current financial circumstances, which means that in today's presentation, we really encourage you all to participate, letting us know if you want to unmute at any point to ask questions or talk, and also to put stuff in the chat. So with that, I'm going to turn everything over to Dr. Frost.
Perfect. So thank you, Dr. Duncan. So the other piece of this, I'm not going to be monitoring the chat myself while I'm presenting, but still put stuff in there. If it doesn't get answered, raise your hand, kind of bring some attention to yourself, because we do, like Dr. Duncan said, want to make this more interactive. I think it's funner that way. So let's kind of jump in. Why is financial literacy important, especially as a high earner? And I want to start out with just some basic kind of examples of the way that kind of money works, either for us or against us. And one of the things I think that is a core kind of principle of wise stewardship of your resources, including finances, is understanding things like compound interest. And compound interest can both build wealth or destroy wealth in different ways. And there's vehicles in which it does those two things that we'll talk about today. So we'll talk a little bit about this first example here is like investing. So thinking of like a $10,000 investment, that on average, over a year returns about 8%. So over the last 25-ish years, the stock market on average has returned about 9.5%. Year to year that fluctuates, but this kind of 8% kind of falls in there. So this would be something like you put in some money in, an index fund in the stock market, you might expect something like 8%. So how that looks is at the end of the year, you would have an 8% annual return, $10,800. So your initial investment of $10,000 is now worth $10,800 after the first year. But going forward, what happens is that $800 you earned in the first year gets added to the principal, and then that is included in the next calculation, such that you'd be at $11,664 next year instead of just an additional $800. Again, this can keep going and going and going to where over the course of 25 years, that initial investment of $10,000 and an annualized return of about 8% would be worth $68,484. That's as if you did nothing else. So the only effort that you made in this example was that initial investment. That's compounding interest. In contrast, when it is destroying wealth is the compounding interest that you might see like with credit card debt or student loans as well to get compounded. So, for example, an average credit card debt, we used from 2018, which is 17%. I just looked this up. The average credit card rate in March of 2025 was closer to 24.25%, so higher. So right now, this would actually be even worse. But let's say you owed $5,000 in credit card debt, and you make the minimum payment due. This is the required minimum to service that debt. You would end up paying $200, but that debt would accrue $71 in interest. So even though you paid $200, you would now owe $4,871. And that, again, keeps accruing over time, such that, again, if you paid this off over 10 years and 10 months with that 4% minimum, you would have ended up paying $2,627 of interest above and beyond that $5,000 that you utilized. So you actually would end up paying more than half of the original debt in interest. So again, you can see how that can snowball. And these are at small numbers. For folks that have watched your student loans as you've come out of, I don't want to bring up like a panic attack, but if you've looked at your student loan balances, after coming out of medical school and going through training, they start to balloon really rapidly because the standard interest rate with the federal government is about 7%. So again, not as high as credit card debt, but that's high. And as it compounds over time, it can really get out of control. So this is the core of why we actually came up with these talks that are now this one talk today, is the idea that, if we can kind of build some literacy and maybe shape some choices for all of us, we might end up in a better financial place. And I personally believe that, if your finances are sound, that you have more decisions. And as healthcare providers, particularly as physicians that are high earners that have a really high risk of burnout, when you have more kind of leeway to make decisions because your finances are good, you can actually modulate some of these other things in your life that actually improve your career, improve your day-to-day function. So that's kind of how we ended up kind of at this talk is really just thinking like, well, how do we actually improve life? And this is one of those kind of pillars or domains. Can we go to the next slide? It's just another way to say it. They're compounding savings, compounding debt. They're one and the same. The wheel's just spinning in different directions. So we can go on to the next slide. So for this one, there are some basic principles. We're going to talk about a lot of stuff today that you don't really need to remember, verbatim. But if you can kind of tuck these basic principles into your back pocket, I think they'll serve you well. So the first one is spend less than you make. Yeah, that makes sense, right? The more you spend more than what you make, you're going to end up in debt and maybe a poor financial position. Save a healthy amount of your income. What's healthy? Well, if you look around, people will tell you different things. It really depends on what your goals are and what your values are. And so there's not really, a kind of, there are rules of thumb, but really they should be utilized in a way that matches kind of your goals over time. So for example, one of the things that I've been recently influenced on was Bill Perkins' book, Die with Nothing. And the idea is that, kind of classically, we save a lot. And then because we're hoping to retire someday. And that day is in the future, quite a ways in the future for many people, where our health and our ability to enjoy life actually is in decline. And so another model would be to save a little bit less, right, up front, because you're working a little bit less, but maybe you work longer. And so, so you end up kind of balancing the, when you kind of semi-retire, move that date forward, you end up saving less instead of saving a ton up front, hoping you can fully retire, day A, you're working, day B, you're not working, sort of thing. So yeah, save a healthy amount, whatever your values, your goals are, kind of how you kind of plan to, retire or enjoy your life, and help you guide you there. Also, know yourself. Right? This comes back to that kind of idea of what are your values and goals? Are you risk averse? Are you risk tolerant? It kind of depends, right, on what you want to do. I personally have retirement accounts that I run by the books. And then I have investment accounts where I take a lot of risks because it's kind of fun, right? But I don't touch my retirement accounts. And so you got to know yourself, know kind of how you can allocate risk and move forward in a way that works for you. And then finally, again, to put that savings to work that you're doing. Think about those financial vehicles that we're going to talk about today. What are available to you, what make the most sense. And then also, I really encourage people to invest for peace of mind. Like whatever your assets should be in vehicles that allow you to sleep at night. If you're awake at night worrying about these things, you're probably in too risky investments. So again, think about yourself. Are you risk tolerant, risk averse? How do you want to do it? You can structure it in different ways to, again, help you sleep at night. So those are kind of the basic principles that most of this will fall under today. We can advance the slide. So 4 different investment terms. We have bonds, which are similar to loans or IOUs that are issued either by a corporation, a local municipality, or the U.S. government. In this case, the issuer promises to repay the full amount of the loan at a specific date. They have a terminus date and at a specific rate of return. So with interest over that time period. Generally speaking, bonds are pretty safe, but depending on kind of what you invest in, like if you invest in junk bonds, not so safe, although you should be rewarded in that situation with a higher rate of return because you're taking more risk. So just because something is a bond doesn't mean it's safe always, but in general, bonds are safer. And then more down below is common stocks. These are securities that represent a partial ownership of a corporation or a company. These have to be issued by the company itself. And again, they're partial ownerships. And so like when you invest in the stock market, you can invest in bond funds. But in general, if you're buying a single type of stock from a company, you're investing in that company. So for example, if you bought Coca-Cola, you are now a partial owner of the company Coca-Cola. And those, again, can be very stable, depending on the company, or much more speculative and have higher risk, but potentially, that should be rewarded in return. Now let's advance the slide, please. So more terms, just continue diversification. This is the idea that you don't put all of your eggs in one basket. So maybe you have some bonds, maybe you have some small cap. We'll talk about this in a minute. I guess small cap, I won't use that term yet. Smaller companies, larger companies, overseas markets versus just the US, these types of things. Diversification tends to reduce risk. So for example, if the one sector of the market is struggling because somebody decided they were going to put tariffs on it, maybe there's another sector of the market that isn't getting tariffed today that is doing better. And if you've diversified, you can take advantage of the strength in one while not getting blown out by the weakness in another market. So can increase your potential for returns. But I really think of this as more of like making you safer in case something kind of bad comes down the pike from a kind of financial standpoint. Dividends, these are portions of a company's profits that are paid to shareholders. So just you own a portion of the company. It has capital that it has brought back in from selling a product or a service, and it has to do something with that money. And so growth types of companies tend to reinvest that money back into the company and growing, so they don't give you a dividend. But if there's not a better way to allocate those funds, then those funds will be paid to the owners of the company. And so, for example, I own Vodafone and AT&T and Verizon, and these are all dividend-paying companies. They pay about 4 to 8% a year, and they just give me money every quarter, right? That's kind of fun as a partial owner of that company. Now, if that company could better use that money to grow, I wouldn't want the dividend. I'd want them to allocate that money in a different way so that the value of the company could grow. But as of right now, that's a great allocation of that money. So kind of fun. Dollar cost averaging. Dollar cost averaging is funny. It means different things to different people in different contexts. This is the idea that you invest the same amount of money at regular intervals over an extended period of time, regardless of the share price. Okay. And so the idea is that you're investing a fixed amount. Some days you buy the shares and the price is a little bit lower. Some days you buy the shares and the price is a little bit higher. Overall, by investing small amounts over time, you potentially save yourself from investing your whole lump sum on a day where the market is very high and then the market drops down and you've lost value. Now, there are some studies that look at this, that somebody who invests, let's say $10,000 on January 1st, actually on average has a higher rate of return than somebody who invests that same $10,000 a little bit of time over the year. But the truth is we don't all end up with a lump sum of money on January 1st. Typically, we're investing every 2 weeks or so along with our paychecks. And so that's a great way to do it. Your dollar cost averaging, some days you'll buy high, some days you'll buy low. Overall, you'll get on average a price in between, and hopefully it's growing over time as well. This does help you avoid the strategy of timing the market. So nobody times the market well, right? I want to buy at the lowest, I want to sell at the highest. What ends up happening is people sell on the way down, and then they have to buy on the way back up. And so on average, retail investors, which all of us are here on the call as far as I'm aware, are retail investors. If we follow that strategy of trying to time buys and sells, we're ultimately going to lose money compared to somebody who just invests in the market continuously, regardless of what's going on day to day. Let's advance the slide. An index fund is it's really just tracking the performance of many investments overall. So many people think of like the S&P 500. If you're a Vanguard person, VOO or VTI would be this. These are like the top 500 stocks in a market for like the S&P 500. And it's just a small portion of each one of those. So when you invest in that index fund, you are getting diversification just by virtue of being having a partial ownership of all of these companies. There are many different index funds with various kind of components or focused on different sectors. So just be aware that that's the idea, though, is that you're buying by buying the index fund, you're buying a small portion of each of the eggs that are in that basket of the index fund. For inflation, this is the rise in prices of goods and services. Overall, this results in a loss of purchasing power. All of us have experienced this over the last couple of years. Eggs, right? How many eggs can you buy right now for $5 versus how many could you buy 2 years ago? It's a great example of inflation. One of the things that is hard is, sometimes people will say, that are very risk averse, I'm going to sit on cash because I know what my cash is worth. If you're going to do that, you have to realize that your cash is susceptible to the effects of inflation. meaning that your purchasing power of that cash will be less next year. So you didn't actually avoid risk. So you have to kind of take that into account when you're thinking about, kind of your investment vehicles and what you're going to do. I had alluded to small cap before. Cap just refers to the capitalization, the market capitalization of a company, meaning how much is it worth? So like a large cap values greater than $10 billion, mid cap values between $3 and $10 billion, and then small cap companies are values less than $3 billion. So you'll kind of hear those terms kind of thrown around. You can also buy into funds that are large cap, small cap, mid cap funds as well. And indeed, part of my kind of by the books safe portfolio has a mixture of each of those companies, funds that are comprised of businesses that are small cap, mid cap, and large cap. So I'm going to advance the slide. This is another way to think about relative risk of investments. Again, not all of these there's nuance to this, is what I want to say. But generally, cash equivalents, government bonds for governments with a high rating are pretty safe. There's other things that are more kind of middle of the road, things like real estate, large small cap stocks, equities. And at the top, thinking about options or futures, or even commodities sometimes, which are future oriented. Where I will say some of the things that I have fun with that I try to do in a safe way to kind of give the nuance here is I like to do covered calls options, which means that I own the stock. I sell somebody a right to buy that stock at a certain price at a certain date. And if the price has not increased to a point where that's profitable, those people don't buy the stock from me, and I keep the premium that I charge them, and it's kind of fun. Now, my risk is that I risk upside, meaning, like, let's say I own a stock and I sell Dr. Duncan the right to buy it next week at $10, and I purchased it for $5, and he paid me $1 to be able to buy it in a week at $10. And next week, it's worth $15. Well, Dr. Duncan buys it from me because now he can turn his $10 he's going to pay me for that stock plus the $1 he paid me for the right to buy it is $11 into $15. So he's gained $4, right? I have also made money, right? I made $11 on this stock that I paid $5 for. So I actually have $6 in profit. Is there a lot of risk to me? No, the risk is to the upside. I missed out on that additional $4. So again, you can think of these things in these different kind of baskets, more nuanced than just high risk, low risk. And you can take your kind of approach to investing and apply it to lots of different types of vehicles or kind of activities. So kind of fun. Let's advance the slide. All right, so sources of funding for retirement. How are you going to fund your retirement? Well, Social Security is one of them. We're all paying into it. We all expect to have at least some funds in there by the time we retire. So there's that. Pensions, we don't see these too often anymore. I have a pension. For those of you in the Mountain West, I worked for Intermountain Healthcare through undergraduate and graduate school, and they had a pension plan while I was there. And so by virtue of being an employee working full time, I have a very small pension. I think it's going to pay me about $3 every 2 weeks, but it's a pension, and I should put that in the calculations for retirement. We have defined contribution plans. These are things like 401ks, 403bs, IRAs. You have individual owned brokerage accounts. So you can do stocks, bonds, mutual funds. You can do other trading kind of apparatus or apparati. Savings accounts, including high yield savings accounts or health savings accounts. You can have continued employment. Some of us may think, I don't actually want to retire. We all know physicians that essentially died in their office, right? Because they just loved what they were doing. And that was just kind of part of their plan, maybe not retirement plan. It might not have been why they were doing it, but some people just choose to. That's okay. Annuities, these are vehicles or kind of things that you can buy into with a certain amount of money that agree to pay you a certain amount of money over time. They have their time and their place. Many Many kind of financial advisors advise against annuities. I'm not going to provide an opinion here today, but I will say if you're thinking about an annuity as your financial plan, I would talk to an expert that is not incentivized by actually selling you the annuity. And so, Dr. Duncan, do you think it'd be worthwhile to talk about that just a little bit more? Because I do feel like this is maybe I will. I'll just talk about it. So if you are to talk to a financial advisor, there are advisors that are fee only, meaning they just charge you for the service, and that's the money that they make. And then there are financial advisors who make money by selling you products. So for example, for most annuities, the advisor that sells you that annuity, that gets you to sign up for it, will oftentimes take 20% of whatever you paid for that annuity as their commission. That creates a strange kind of dynamic, right? Where somebody's actually incentivized not based on the advice they give you, but based on the product they sell you. Again, I don't think that's always a bad thing, or that you're going to end up in a bad situation by seeing a financial advisor who's doing that. I strongly believe that you're probably in a better situation of getting advice or expert opinion from somebody who is not incentivized in that way by selling product. You can also, for most Americans, their home is actually their largest kind of financial savings or vehicle, like their asset, their largest asset. And so there are ways that you can use your home equity into retirement, reverse mortgages, things like that, selling it, downsizing, and using that equity. So that's something else to think of. In northern New Mexico, one of the things that I see quite frequently is, if not these financial vehicles, then what? So those are just people hope family's going to take care of them, hope there's a program that's going to take care of them. I don't want anybody that's on this call to be in that situation. And so again, that's why we developed this talk, is that yes, though, it'd be great if we did have some folks that would step in, but there are mechanisms that you can deploy right now to improve your overall financial health as you get older and less capable. So yeah, those are different sources of funding. Let's go ahead and advance the slide. So for this one, we had Social Security as the top item in the last slide, but why not just rely on Social Security benefits? Well, the rule of thumb is that you should have about 70–80% of your pre-retirement income for retirement. With that being said, the data suggests that spending tends to trend downwards as we age. Meaning if you retire at 65 and you need about, in this case, $157,000 to $180,000 a year, by the time you're 80, it's unlikely, unless you have significant medical expenses, that you're actually spending that. And the reason being is that we tend to travel less as we get older. Things tend to be paid off. We're not buying a bunch of new fancy clothes and things like that on average. So I do like this 70–80% rule of thumb, because it essentially it doesn't guarantee, but it puts you in a better position to not have to deal or be confronted with lifestyle change choices, right? That you're able to maintain your same standard of living. But again, that's probably on the high end of what you would need over time. Also, so again, the question is, why not just rely on that? Your Social Security benefits are not going to get you to $157,000 to $180,000 a year, right? The last time I checked, it runs about $6,000 a month in Social Security benefits for me, as somebody who caps out the income tax, as all of you will, right, if you're working full time. So what I mean by that is that Social Security is only calculated on the first about $160,000 of your income per year. And so after that, you actually don't have that deducted from your paycheck. And so for those of you who are making a full salary or income now, you'll notice around August, September-ish, your paychecks suddenly go up. And so why is that? Well, it's because this is no longer being taken out. You've hit that threshold, which is adjusted every year, upwards, never downwards. And you're actually taking home the rest. So anyway, you can go to the Social Security calculator If you want to kind of figure out what your benefits are, you can actually look into what you've contributed. Kind of cool. You have to create an account. Kind of cool. So go ahead and advance the slide. So what about individual retirement accounts or IRAs? So these are long-term investment accounts that individuals with earned income can use to save for the future while enjoying certain tax advantages. And so many of the things we're going to talk about now are tax advantage. And what we mean by that is that there are tax benefits to utilizing these vehicles, such that either you don't pay taxes up front when you put the money in, and you pay taxes when you pull the money out after it's grown over the years, hopefully at a lower tax bracket, or alternatively, you pay the money up front, and then when you pull it out later, it actually isn't taxed, including the accruals over time. So that's what we mean by tax advantaged accounts. For IRAs, though, they're designed primarily for self-employed people who do not have access to a workplace retirement account, like a 401k or a 403b, through their employers. There are different types of IRAs. So there's like a traditional IRA, there's a Roth IRA, a SEP IRA, a simple IRA. I'm not going to go into all those details. There are ways to access these accounts through loopholes in the current tax scheme. So for example, I contribute to a Roth IRA every year, even though I'm not eligible for a traditional IRA. It's a multi-step process. You have to invest into a traditional IRA and then move it out as quickly as possible to the Roth IRA through a conversion. The White Coat Investor has a really good write-up on how to do this if it's another thing that you're kind of interested in. But just know, again, for everything we talked about today, like most complicated things, it is nuanced. There's ways to get around certain things. Today's talk is not meant to kind of walk you through that or feel necessarily comfortable doing those things. But I think it would, this wouldn't be a complete talk if we didn't mention that there are ways to kind of take advantage of lots of different retirement or savings vehicles, investment vehicles that maybe wouldn't be presented to you as you kind of, your HR onboarding when they talk about their available vehicles. Let's advance the slide. So what companies, brokers offer traditional Roth IRAs if you're going to, kind of set one of these up on your own? Lots of them. Many of them are very similar. If you were thinking about doing something through one of these companies, I would look at kind of multiple and just kind of figure out which one kind of feels better for you. My personal investment account that has my Roth IRA in it is through Vanguard. It's fine. Their options trading is pretty poor. So if I was going to be more focused on options trading, I would probably use a different company. But again, if that's not something you're interested in, Vanguard's a great company, great access to different funds. Fidelity's good. I have Fidelity for my kind of standard by the books investing for retirement. But there's lots of them out here. This is not a complete list either. So just know that it's worthwhile to do a little bit of investigation to see what kind of GUI feels best for you or interface. Let's go ahead and advance the slide. So what about employer-sponsored retirement plans? Well, there's 403Bs. These are for nonprofit organizations. There's 401Ks. These are corporations. This excludes state and local governments unless they were grandfathered in. Again, talking about nuances. And 457Bs. These are state and local governments, tax-exempt organizations under a different kind of IRS code. These are things that are organizations that are excluded here would be Indian tribal governments, steeple churches, qualified church-controlled organizations like church secondary schools and that sort of thing. Typically, your employer will just tell you what they offer, right? If you're going to be with an organization, and that's what they are. One thing that you'll want to do if you are employed by an organization or offered a plan is look to see what the fees are associated with those plans. And in general, you're going to be better off selecting the plan or the manager with a lower fee structure. So for example, when I was first hired on to Christus, they had two different managers of their 403B plan. And both of them had high fees associated with them. I selected the group with the lowest fee. And because of how high the fee was for money under management, I actually put more money into my personal investment account. They've since switched over to Fidelity with much better management fees. And now I feel more comfortable actually maxing out that plan here because it's lower kind of fee for management. And I feel like I'm getting more bang for my buck. So let's go ahead and advance the slide. I love this slide actually. And so, because in some ways it's counterintuitive, or aspects of it are. The question is, should I pay off my debt or save for retirement? We don't have to do a poll, but for everybody, just maybe think, when you think of your debt, does that feel like a bigger priority than your retirement right now for you? I would guess that a lot of people would say, yes, I'm far away from retirement. My debt is staring at me down a barrel, right? But that may not always be the soundest judgment when we think of dollar for dollar, from a financial standpoint. It may be the best judgment from your own kind of personal well-being and health, but from a financial standpoint. So let's talk about this. So first of all, return on investment. This is the approximate measure of an investment's profitability. For what you put in, what percentage of return do you get back? So you always want to think of return on investment. This can be positive and negative. So for example, a credit card debt at a 20% annual percentage yield, or kind of a rate, what is your return on investment on that credit card for carrying a balance if you kept, you owe the credit card company money? What's your ROI? This one I do want the audience to chip in. Anybody want to take a stab at it? All right. What?
You're losing money by carrying the credit card debt.
Yeah. Yeah. So what's your ROI at this point then?
I don't know what that means. I know what that means, but I don't know.
It's your percentage, right? Negative. So your ROI on the investment was the money you took from the credit card company, right? You are negative 20% ROI on that investment. All right. So this is the counterintuitive part here, though. So let's say a company matches your 401k up to 4% of your salary. What's your ROI on your investment up to 4%?
No. 8%.
So think of it this way: for every dollar you put in up to 4%, the company gives you $1. It's 100% plus whatever that dollar does.
And what you put in.
So let's take your student loans. Let's say your student loans are 7%, right? And so that's what you're paying to service that debt every year. Your ROI on your student loans, if we discount, your educational, what it's actually paying, technically your salary is a return on investment for student loans. But let's just say it's just 7% to manage that debt. So it's minus 7%, right? For a 401k or any type of match program, you're getting 100% return on your money up to the match, plus whatever it does in the market. Now, after that, it's whatever the return is from the market, right? So if you put in 5%, dollar number 5 only gives you whatever the market returns. And so my argument here would be, you would be possibly an idiot if you didn't invest up to match the match for your company. Just when we like put it on paper. Now, again, that may not be true, right? There may be certain circumstances where for you, you need to pay off that debt first, a credit card, in this case, 20%, or you want just whatever reasons you want to have no student loan debt, whatever it is. It may make sense that way, but it doesn't make sense from like a math standpoint. It's something else that's going on that would have to influence that decision when you're talking about a match. After the match, it's a little bit more murky. Again, what are these numbers aren't the whole story. What is being debt-free worth to you? A recurring payment, that sort of thing. And I think at the end of the day, be reasonable, and reasonable people can disagree.
Pre-tax. The other thing, Brock, you forget is there's a tax advantage because you're not paying. Most of you guys are going to be in a 24% tax bracket for federal tax. Unless you have a partner who makes just as much as you, then you'll be in a much higher bracket. And so what happens is the game is to put it in so you don't pay tax and then amount. And hopefully you'll take out a fraction of that. And when you're older in retirement, so you were at a lower tax bracket than when you're earning money. There's that part of that's the financial equation. If you can, keep it that way.
Yeah. It gets really complicated, but there are ways to do this. Where you could actually pay almost no taxes. So right now, for example, you can pull out about $80,000 a year in long-term capital gains tax-free, as long as you don't go above that. So there's different ways to game the system, but almost always, in almost every circumstance, investing up to whatever your employer matches, if that's the mechanism that they have in place to encourage you to invest, is going to be better for you long-term than paying a debt, unless there's something else going on for you that kind of changes the story. So, all right, let's advance the slide. So another way that you can do this is thinking about that I mentioned earlier, continued employment. So there's no sense in going to full retirement or with ongoing financial obligations that require a steady income, unless you're willing to have, again, maybe steady income, but maybe at a less or at fewer hours, right? Also, as some people retire, this is particularly true for men. The data that we have anyways, first year after retirement from older men tends to be pretty good. And after that, health and mental health seem to decline. And that can be a crisis of meaning for some people, and purpose and things to do and structure. I don't think that's solely, associated with men. I think that could be true for anybody, but something to think about, particularly coming from a physician's role where tend to work more than your standard number of hours per week. So thinking in this situation, consider part-time, short-term kind of locums contracts or consulting types of things. Also, many folks do choose to pursue a second career or a passion career. When I was at Intermountain Healthcare there in Salt Lake City, one of the neurologists there finished paying off his student loans, paid off his house, and then decided he was going to pursue his true passion, which was photography. And so in his mid-50s, just retired to become a photographer after he paid off his major debts. That's awesome. It's awesome to have that opportunity, right? And again, if you kind of take care of your financial well-being, you may also have opportunities like that. Let's go ahead and move forward one slide. So other things to consider, no matter what your investing style is, whether it's risky or more conservative, or if you're starting late or if you started early, it's important to set a goal, right? Understand why you're investing, what you're investing for, have discipline as you pursue that goal. But also, I guess I'll say this later, a little bit of flexibility in there in that discipline, and saying that, life changes might kind of change what your plan is and what your goals and what your means are. Over time, patience is the key. The compounding interest takes time. Once that snowball gets rolling, though, it can be quite impressive. And then finally, diversification. Again, it's really important when we think of financial well-being and safety is to not have all of your eggs in one basket, so that you can weather financial storms and know that you're going to get through it, which allows you again to have discipline and patience. So I think we have one more slide for me, and then we'll turn it over to Dr. Duncan. So this is the start of why do people borrow money? All of us borrow money. Many of us borrow money to get where we're at, right? For education, but things like buying a house, home improvement, building discipline and credit is another reason that some people borrow money, at least initially. Freeing up some emergency funds. You have the money to pay for something, but you want to leave it where it's at. Starting or growing a business, unexpected large expenses or bills, the car breaks down, you don't have the emergency funds, you borrow for that. Purchasing a vehicle or opportunistic investments. So something comes up, you don't actually have the cash on you right now, but you feel pretty good about it, so you borrow some money against the future returns on that investment. So those are different reasons why folks might borrow money. Dr. Duncan will take it from here.
Let's see here. I'm going to go ahead and get us advanced over here. So just so we have plenty of time to talk at the end, I think the groundwork that Dr. Frost already laid is excellent, and I think will lead to having some better conversations for now. And just know that what we'll do at the end is we'll share all the slides with you all to fill in some gaps and some areas that we might have to go through a little bit quickly on the second half here, just so that way we can really get to that, the good meat and bones of discussion here toward the end. So let's just answer this question up front. Is all debt inherently detrimental to financial health? In short, no. And for the reasons that Dr. Frost kind of already went through, debt in and of itself is neither good nor bad. It's neither positive nor negative. It really depends on your purposes for it. And there can be some really good reasons to have certain types of debt in certain parts of your life. For example, there are good reasons to have credit cards in certain parts of your life, which are considered forms of revolving debt. So these are the types of debt where you're given a line of credit. Your creditor usually will let you do whatever you want with it up until that point, and you're expected to pay it off. But with the trade-off being that you often will see high interest rates, things like that will ultimately sway the way that you go about using that credit in the future. Most of us are pretty familiar with installment debt, which can be secure or unsecure, depending on how you set things up. It basically comes down to whether you have something on the line for that, some sort of collateral. But these are things like personal loans, student loans, mortgages, auto loans. Actually, for some of you, you might be thinking you may have all forms of those as the examples given. But debt, again, it comes down to your purpose and your ability to repay it. So let's get to talking about that repayment side of it. So it might go without saying, but I think when you're looking at debt, and especially as you get more established in your careers, the amount of debt you have can be about as complex as your investments that you have. So it really becomes very important to take inventory of your debt and to keep revisiting that and keeping an eye on it. So nowadays, it's pretty easy. A lot of companies have apps available, websites where you can monitor things pretty easily. There are even special services available to consolidate all of that. And so there are ways to watch this and make it pretty low effort for you to keep an eye on what's going on. But the other side of it too, which actually is helpful if you're watching your credit report and kind of thinking about the different accounts you have open, is whether you do have predominantly things like revolving debt, so credit cards and the like, or mostly installment debt, things like mortgages. But the other side of it too, and we'll talk about that 50-30-20 rule in just a moment, but mostly considering your strategy. What is your budget for repayment? How are you going to tackle it, and by when? Because if you don't have a strategy, this is where people get into some tough spots with their debt. And this is where, I think a lot of people can start to cast their debt as being mostly a negative thing or something that kind of rules your life. I think a lot of us have heard a lot of the news reports for several years about, people in their 60s, 70s finally paying off their student loans, for example. And so we'll get into talking a little bit more about that in a bit. But broadly speaking, some of the biggest things you really want to think about is the timing of your debt, how you can repay debt when you're taking on new debt, and also thinking about the role of credit counseling in all of this. So having somebody there to really review this for you, to point out, areas in which, like Dr. Frost pointed out earlier, where you could get trapped in kind of this debt avalanche, this debt snowball, where you're just paying on interest. And if not being careful with that, you could end up, in that perpetually. And so you go very far into life before you really, clear off some debts that started very early on, including right now. So this is one where I want to kind of give a gold star moment that once you get the slides, just to go back and look at this again, most people are pretty familiar with, the idea of a credit score. On the next slide, I'm going to talk a little bit more. The diagram on the right just gives a good breakdown of some of the main buckets for your credit score. The most commonly used one you'll see for most companies will be your FICO credit score, which is also one that's pretty commonly used by major lenders when you're looking at getting an auto loan, home loan. But also be very careful with this because some companies actually do present you with different credit scores. So Vantage is another really common one in the United States, but there are plenty of other ones, and the scores are not equivalent between the two. They should be more or less similar when you look at them, but some use different scales, some have different factor calculations. And to speak to that, at least from FICO standpoint, I wanted to show this because most of us know that the most important thing that you can do to really, keep a credit score at a healthy level is, by and large, one, make on-time payments and make them consistently. If your payment history is the biggest single factor out of all of that, but then the other side, the other one that's a pretty close second is your accounts owed. So this is how much of your credit that you're using at any given time. The rest of it actually boils down to about the same chunk as payment history, with credit mix, length of credit history, and new credit. And so the spot that a lot of people talk about is that inflection point of 30%. So generally speaking, below 30%, you start to see benefits, but also knowing that as you get below 10%, there are additional benefits there. And so just for the sake of time, we're not going to go too much more into that for now, but there will be some more information you'll see here later. 3 major credit bureaus. I think a lot of us have heard them for good and for bad because we've had some security breaches with, I think, all of them at this point. And so data has been leaked, from time, in different breaches over the years. And some of these have actually been very, very large. So all of these services do allow for security freezes on your credit, which means nothing comes in, nothing goes out. And you are entitled to access your credit reports as the results of the Fair Credit Reporting Act. And so it's just something to keep in mind that you want to also, while you're watching all of this, you do want to keep an eye on all 3 credit bureaus because those do come into the consideration for lenders when they're looking. And sometimes there are situations where one credit bureau may have information that others don't, or may have erroneous information that could severely disadvantage you, especially when you're going to try to borrow money. So, let's see here. So we talked a little bit about this. So just some more information for later on the difference between revolving and installment debt. Mortgages, just a note on this. So for the folks in the room and healthcare, there are specific physician loans, which I'll have just a moment to talk about, or a little bit to talk about in a moment. But there are plenty of other ones, and just because the physician loan is available doesn't necessarily mean it's going to be the best option at all times. One of the big advantages of it, much like VA loans and other ones, is you don't have a down payment for qualifying for these loans. There's also, in physician loans, you also don't have a private mortgage insurance. But that being said, those same benefits can actually be applied through conventional loans if you can come in with a large enough down payment, because basically the way a lender looks at it with a down payment is a security on their investment in you. So if you come in with more money, say like 20%, a lot of times they will waive a lot of fees and a lot of other basically what become taxes on your loan over time by you coming in and showing a lot more security in it. This is a quick one from the White Coat Investor to talk about that. But with that being said, too, just kind of be mindful of our time. I do want us to get to talking a little bit more. So some of these other slides I'll just mention really fast have to do with your debt and the amount of time it takes for many people to resolve their debt. Loan repayment programs, we do have a good, list of these. And like I said, I'll make sure you all have the slides so you can go and visit these if you're interested. Some of these programs have both loan repayment as well as scholarship options. So just be aware that things like the National Health Service Corps, which is what I'm in, has those different pipelines or pathways rather. And there are some that are specific to New Mexico that are worth looking at, which I have on this slide. But some of these other ones are a little bit broader. The 50-30-20 rule, just something that I want you guys to keep in your back pocket for later. But just remember 50% needs, 30% wants, and then about 20% into your savings on a regular basis. So yeah, for now, what we'll do is we'll just we'll have to skip this portion about taxes, but this is really important to look at. Dr. Lax mentioned earlier about your tax brackets, which is a really important thing to consider. These are marginal tax brackets too. So the way the United States kind of looks at your income has to do with where you fit on the spectrum across the brackets. And we could talk more about that with a little bit of time we have left. But let me go ahead and just get us to our group discussion. So we want to hear from you all. What questions do you have? What thoughts do you have? We have some questions up here to kind of prompt those discussions too, but we have a little bit of time left. So what do you all have on your minds right now?
Tariffs, no.
What are your thoughts on cryptocurrency?
Don't.
I'm good. Again, we can give financial advice right now. I will say that different people have different thoughts on it. I personally am not, and I have no intention to invest in cryptocurrency. But it is something that's becoming really commonly discussed, and there's a lot of trading happening too, where it's gotten really interesting. Where people are using crypto to invest in stocks, to buy portions of companies like Dr. Frost was referring to earlier. So it's just become interesting. It's also something that you're also hearing on a lot of politicians' tongues recently, which is also kind of interesting to associate American policy with something like cryptocurrency. But unfortunately, that's about as much as I can say on that piece right now.
I would add this.
Because there is no productivity of a national economy or a tax system behind it, like U.S. Treasury notes. It's a currency that has no value outside of speculation, so it could fluctuate wildly. The other problem is you have to keep all the numbers of your cryptocurrency, because if the electronic system is hacked or destroyed, it's lost forever. There's very little security in this. I'm trying to sell it. I've never asked anyone if they tried to sell crypto. Kind of a nebulous gray market, underworld market and stuff. I don't know what you feel about it, Brock. I just feel there's no government that's actually, our government, is trying to put up the gold reserves to buy crypto, which I think is a taxpayer disaster.
The time to buy crypto.
Yeah.
No, I would recommend that anybody who's interested in crypto to look up the greater fool theory of financial investment prior to doing so.
Yeah.
That's my position.
Yeah, I think that's a fair one.
Fool's gold.
Well, that's a good question though, especially if America tries to have a centralized crypto currency bank.
Yeah. And just to also, kind of weigh in on one other piece is I think, based on everything we talked about today, you have a lot of options about how you invest your money, what you do with your money. I think it's always important to know too that companies are changing constantly, and to be aware that if that's something that you have strong feelings about or want to either avoid or get involved with, just be aware of what other companies are doing in that space too, because the economy is changing constantly, and I think we're seeing a lot of changes, coming up with some upcoming policies that you all may have been seeing in the news. So just watch for that over time too, because I think that's another important piece is that you don't want to just kind of fire and forget with your money. Just, keep an eye on what's going on, how your money's being used, and what companies are using your money to invest in.
That is one of the nice things if you know that you're the type of investor that's kind of hands off. Is index investing, that's essentially what that was created for, was folks that don't want to manage this day in and day out. So just know what your strengths are, what you're actually going to, the effort you're going to put in, or you want to put in, and then pick a strategy that works for you.
Yeah. So we're kind of a little over time here, but is there any last minute question or anything else that you all have from today's presentation, or just a general reflection on your financial situation or kind of what you think you might be doing in the future? Yeah, because if we don't have anything right now, Dr. Frost and I are available. We're happy to chat. Like we said, we're not, financial experts by any means in terms of, being able to provide advice, but, we are happy to, support everyone. And, I think it's also just good to have, good, healthy discussions about your finances. So we really appreciate your everyone's time today, your attention. Like I said, for everyone involved, we'll make sure to get the slide deck out to you all, just so you can take some extra time to really look things over, and just consider things down the line. But we appreciate you all letting us come back around to reprise this presentation on a really important topic. And coming next month, we're going to shift gears a little bit to talk about public scholarship. So I'll be having some more co-presenters at that time, and we'll keep things moving along, and hopefully, lead to more, thoughts about how you all can evolve your careers over time. So we really appreciate it, and we've got some stuff in the chat too about our sessions coming up, and then feedback. That's another one that we really, really value. Please give any and all feedback you have about today's session, or what you'd like to see going forward.
Thanks, everyone.
Thank you, everyone. Like I said, there's a bunch of stuff in the chat. Also a registration link for May and June didactics lectures, and also Emerging Leaders workshop coming up on May 7th. So thank you.